Welcome, everybody, to another episode of Paving the Way Forward. Today, we're going to talk about demystifying credit scores. I'm so pleased and honored to be your host today. I am your Radio Love Asia. I'm an on-air personality with both Radio One and Urban One. And joining me today, I have some awesome people hanging out with me as always. So please welcome Rulon Washington. He's the Executive Director of Mortgage Sustainability and Business Execution with Wells Fargo. Hey, Rulon.
Hey.
We also have Martin Sanchez. He's the Executive Director of Mortgage Sustainability and Business Execution with Wells Fargo. Hey, Martin.
Asia, how's it going?
And Herman Palmer. He's the Senior Vice President of Outreach and Inclusion for the National Foundation of Credit Counseling. Hey, Herman, how are you?
I'm doing well, Asia. How are you?
I'm good. You know, I love hanging out with you guys, right? We're back.
Yes.
We're back.
We love you back.
So here's the thing. Purchasing a home is probably the biggest investment most of us will ever have in our lives. Like, you know, there are a few people that will buy planes and boats. I'm not one of those people. I wish I was.
Not yet, anyway.
You know what I mean? But for the most part, that home or your dream home, your forever home, or even a vacation home, that's going to be like the largest purchase of your life. So Here today, we need to talk about how to get started. Like, where do we even begin? And like to try to let people know about what options are out there and try to stop the confusion, if you will. There's a lot of people that kind of just tell you stuff and you just listen to what they're saying and they really don't know what they're talking about. So we're going to start off with understanding the basics. How's that sound?
Sounds great.
Awesome.
Okay. So there's some terms that we always hear. Like we hear like loan to value. We hear debt to income. Down payment assistance. Like, but to someone who has never purchased a home, that's like a foreign language. You're like, what? So Martin, explain what a loan to value is.
Yep. Thanks, Asia. Yeah, we want to make this really simple for the audience so that, demystifying mortgage and the mortgage process is actually it's not so bad. So loan to value, sometimes also called LTV, is a percentage. So the easy way to get the percentage is your the mortgage amount you're going to get divided by the home value. So, for example, you're getting a loan for $400,000. The home is worth $500,000. That is therefore an 80% loan to value.
Okay.
Now, why does this matter? The reason this matters is that if you are 80% LTV or below, that typically means you do not have to pay PMI, which is private mortgage insurance. And if it's anything above that, typically you do have to. How much is this PMI? So it can be anywhere from 0.5% to 1.5%. So if you do have a bigger down payment in order to decrease that initial loan amount, that'll help you down the line, because if it's below 80% LTV, you won't have to pay that private mortgage insurance. It'll make your monthly payment smaller, right, for the life of the loan. And then, how do you get there? How do you have a bigger down payment? We'll cover that a little bit later in talking about down payment assistance programs.
Okay. So, but Rulon, talk to me a little bit about PMI, because he's touched on it a little bit. Now, most people advise you to pay your principal, interest, taxes, and insurance, your interest, taxes, and insurance, to get it all out of the way, especially for those who have had difficulties with payments in the past. It almost keeps you on track. You got your insurance paid, you're paying in that interest. What's the difference between just the general principal loan and the PMI, and which one would you advise?
That's a really good question. So when you think about your principal and interest in your payment, right? Principal is you paying down the amount that you borrowed.
Right.
The interest is what you're paying back to the bank for allowing you to borrow that money in advance, right?
Right.
So when you're paying those two, you also have your property taxes and your insurance if your mortgage is escrow. So a lot of folks get private mortgage insurance and homeowners insurance a bit confused. Homeowners insurance is essentially protecting your home, your asset, right? So you need coverage if you have a mortgage. So if there's a storm or if you need to do anything to the home, then you can rely on your insurance. So you're paying that each month, right, through your mortgage payment. When you have private mortgage insurance, essentially that is the lender's way to make sure that you are paying additional costs because you
Okay.
weren't able to pay a larger amount at the beginning of the loan to pay down the principal, right? So
Okay.
Martin talked about loan to value. When you think about when you're getting into a home, a bank or a lender may say you need to put 20% down. I don't know about everyone else, but I don't have
Nobody
20%
has
down to
that.
put on, right?
No,
So
that's
they have
unheard of.
programs out there that are, yeah, that are like 3% or 5%.
Mhm.
Usually that means that you are bringing some money to the table, but you're not bringing that full 20%. So more than often, when there is a lower down payment associated with the mortgage, you might be required to pay that mortgage insurance, which allows protections for that lender to make sure that you continue to pay on your mortgage.
Okay. Okay, that makes sense. So some people do get that confused. So PMI is
Yeah.
very different from your actual mortgage insurance. As
Yeah,
opposed
from your
to like,
homeowner's insurance. Yeah, that's correct.
just
And I'm
like
glad that
guaranteeing
exactly. Yeah.
the
So
loan.
exactly. So talking through it is helpful because you have folks that are either beginning this journey of homeownership, or they're currently in the journey of homeownership, or they've already started their process of homeownership, and they're not sure what those terms mean, right? And
Right.
so homeowners insurance, you're going to have that because it's protecting the asset, just like car insurance would,
Right.
right? But when you're not able to put enough down, there is a chance that you will have to pay an additional cost, and that's what the PMI is. It's an additional cost associated with your mortgage.
Okay, and that's just a fee that you pay separately. That's nothing that's applied to principal. That's nothing
No,
that's
it's
applied
it's
to
it's
loan.
all
It's
it's
just
all it's all gobbled up into your mortgage payment each month.
okay. I see you, Herman. You're shaking your head. You're like, no, no. That's why
Yep.
we need credit counseling. That's why.
There you go.
Right.
That's it.
That's right.
Talk to us about the nonprofit credit counseling. Let us know a little about that.
Sure. And I'm going to be real specific because I'm going
Okay.
to talk to you about a HUD certified nonprofit credit counseling agency.
Okay.
And this refers to nonprofit agencies that are approved by the U.S. Department of Housing and Urban Development, HUD.
Okay.
And they provide financial management, budgeting, and credit counseling services. This is very often tied to housing issues like preparing for a mortgage to qualify, or mortgage challenges when you're looking for forbearance or a workaround or workout or reverse mortgage. And a HUD certification is important because it's like a good housekeeping seal, indicating for consumers that they can be confident that this provider is a trustworthy resource.
Mm-hmm.
It effectively means that the counseling agency and its counselors are officially, you want to be official,
Right.
officially trained, tested, and overseen by, and in accordance with HUD's standard to deliver housing and credit related services. So these agencies typically are nonprofit like the National Foundation for Credit Counseling, NFCC, or they are government entities that are participating in HUD's housing counseling program.
Okay. So it keeps them on their toes. Keeps them okay.
Yep.
All right. I think that's dope.
It's a layer of
Mark,
protection.
Yeah.
protection is always needed, especially when you don't know what you're doing. So like as you're kind of learning as you go along, you do need those that the comfort of knowing that you're gonna be walked through the process the right way. So we touched a little bit about loan to value. We also talked about debt to income. Like when people hear that, they think of algebra, they're like carry to one, they're like trying to make it make sense.
Naught.
You know what I mean? So Rulon, walk us through exactly what DTI is, debt to income.
Oh, that is, I love the way you put it, AJ. It feels like a math equation, right? And because, forgive us from the bank's perspective for using so many acronyms, right? That's just the world that we're in finance. Acronyms are easier because there's usually longer terminology, but debt to income is exactly what it sounds like. It's how much you owe versus how much you earn.
Mm-hmm.
That's essentially what it is. Now, that ratio will be used by lenders to determine how much you can actually afford. So an example would be this. If you make $6,000 a month gross,
mm-hmm.
and you have $2,000 in expenses, let's just say your rent or your mortgage, car payments, other obligations, then your debt to income is 33%. So essentially a third of your money, right, goes towards your bills. When you think about a lender is looking to make sure that if I let you borrow this money, are you going to be able to repay it?
Yeah.
The higher the debt to income, the higher the chance that you may run into a life hurdle that may cause you to not be able to pay your obligation. So an example is this. If you have 50% debt to income, it's really difficult for a lender to loan you the money. Because if you're making $5,000 a month gross, right?
Mhm.
Not net, gross,
Right.
and your expenses are 2,500, right? Car repair, home
Right.
expense, medical bill, that'll throw everything out of whack. Now the question will be, from the lender's perspective, how do you repay that loan knowing that your ratios are really, really, really tight? So a
Right.
good window is usually under around 35 to 36% debt to income. That allows the lender to understand, especially when you're getting a mortgage, hey, there could be some life instances that happen that cause some additional expenses, but they can manage it because their debt to income is lower. So when your debt to income is lower, it's more attractive to allow lenders to let you borrow money. So it's not a crazy math equation. It's as simple as how much you owe versus how much you earn.
Right.
But
And
you
I
got
don't
to
know
know
if
what you make, and you
right.
That's
got to know
correct.
what your expenses are. So you
That's
got to.
correct.
It helps the budget.
Yes.
That's
Yes.
correct.
Have you
That's
guys, I
correct.
know I've seen them a lot on social media and things like that, but have you seen those ads that talk about, having 50 and 55% DTI that can still get you done? Those are scary and alarming because I was trying to think. I'm like, I've never heard of any such thing. What is the look at her mom? He's like, no. What is the maximum? Like, is 35% like the maximum typically with
Well,
lending
yeah.
process?
So 35% is like, it's a sweet spot. That's a really good spot to be in. Anything lower than that, you're in a really good position, because that just
Right.
means that you are making a nice amount of money and your
Mhm.
expenses are low. The higher you get, once you start to delve into those 40, 45 to 50, it's really hard for a lender to be able to lend you money if you're looking to buy a home. Now, there may be some lenders that have concessions and allow you to have 50% debt to income, but you have to have everything else in play. A
Gotcha.
really high credit score, tons of reserves and assets, right? So it'll offset the debt that you have. But
Gotcha.
it's really hard to play in that space because, as I mentioned earlier, one thing goes wrong, it throws your whole budget out of whack. To Herman's point, budgeting is so critical just to understand, really look at your pay stub and see how much you make, right? It's the
Mhm.
first thing, how
Yep.
much do you make, and then
Yep.
budget and see how much you actually have to pay out each month. And then you're able to do that math equation on your own.
I
Yeah,
think
that
one other thing is, if you're going to put down a monster down payment,
Mhm.
just a monster down payment, and I
What's
say
a
monster,
monster down payment, Irma?
monster, because
Monster.
that's skin in the game. And,
Yeah.
and lenders look at it and they say, well, they're going to put down 75%.
That's right.
It's highly unlikely they're going to be willing to walk away from this deal or this property somewhere
Right.
down the road.
Right.
Look for the monster down payment, though.
That house must be $5,000. No.
Playhouse.
Put down 75 on that. What were you about to say, Martin?
Yeah, so I was gonna say that when it comes to DTI, debt to income ratio, we talked about the risk to the lender, right? 35% is a sweet spot, but it's also, I mentioned, it's a risk to you as a homeowner. For the next 30 years, you have this home. What if someone gets sick? What if you're depending on someone's salary? There's a divorce. There's just your car breaks down, flat tire, whatever it may be. You want to have that buffer in your monthly budget so you can cover those emergencies, those things you don't anticipate. That's why 35% debt to income is a nice spot to be in, both from a lender's perspective, but also you as a consumer.
Good
That's
point.
awesome.
Good point.
That's awesome.
Good point.
Someone just asked, what's the difference between a credit score and a credit report?
Wow, look at that.
All right.
Feels like we were on the right track.
I think
Yeah.
all of you can answer that.
All right. So a credit report is the data that's collected around what you've lended, what you had lent to you, and then your financial capabilities, right? So they're credit bureaus that capture information from when you apply for a mortgage, an auto loan, a credit card. And the credit report is where all that data is housed, right? Your credit score is essentially a score that's created, built up on all of your debt from out of your credit report to give you an actual score, to shows how credit worthy you are to lenders in the future, right? So it allows you to understand how much you've borrowed and be able to get a snapshot, so that way in the future, when you borrow, you understand where you are from a credit worthiness perspective. So there is a threshold, and I think we're probably going to dive into that. So, gentlemen, you want to add something to it too?
Yeah, I will break it down like this. I'm going to take it out of the housing arena. I'm going to say your credit report is like your report card from school.
Yes. Yes.
It tracks how well you are, how well you do with paying your financial obligations. Your credit score is a snapshot, your grade. So you got the report card that goes through the detail of everything that you got, and the score is the grade. The higher the score, the better the grade.
There you go.
Like
there
that.
you go.
I like that.
So I was explaining to a girlfriend of mine who couldn't understand why she couldn't get approved. She was like, I don't have any debt. She was like, I don't have any debt. I was like, well, you have to understand, if you use your credit card and you spend $1,000, but you paid $1,000, then you've paid it off. You don't have a score. They haven't had the ability to grade you. I was like, credit is the ability to repay a debt. So if you don't have a debt, they can't grade you on your ability to repay. And it took me so long to explain this to her because she couldn't grasp that. Maybe I'm saying it wrong. How would you say it?
No, you're right on point, Asia. I mean, it's you know, I have a niece who has a credit card, just a credit card, right? She worked really hard, paid for her car in cash, saves up her money, great with her finances, but she doesn't have a credit profile.
No.
She only has one credit card, right? And so there's parts and factors that create a credit score, and you have to meet some of these factors in order to actually get a score. So just having a credit card isn't the one thing you do, right? Obviously, paying off that credit card, making sure you're making on-time payments will give you a positive outcome, but you have to have what's called a credit mix, right? And that's having different parts of credit that allows a credit reporting bureau to understand your credit worthiness. So that's having an auto loan, a credit card, a mortgage. Those things are attractive because it shows that you can manage that obligation. From a lender's perspective, when they are looking at your score, they want to be able to understand your credit mix, right? Your utilization. How much do you use each month as far as the money that you're allowed to borrow from a credit card, right? So you said it correctly. And I think that's one of the great things about our platform is we're able to break it down to the micro level and really talk about some of the details around that, because you gave her really good advice. Now the goal is for her to continue to go deeper to understand what her score is. How can I get a higher score? What is a credit mix? And so we'll cover some of that today, but you led her on the right track. You let her on the right track.
I was even trying to use your credit terms. I was like, I think that's called thin credit. I don't know if I was right, but I was like, that's thin credit. You need thick credit. You know, like
thick credit.
Robust.
Yeah, but I was clear things up. So we don't encourage you to hold on to, pay $1,000 and leave it on the credit card and earn interest on it. We want you to pay it off. It's in everyone's best interest to pay it off in full, and that will help the credit eventually too.
So so if I use it on Monday and I get paid on Friday and I pay it off, that's what you want? Or isn't there like a formula to it? Like, how would you advise that? Because you want us to pay it off right away.
Your credit score. Your credit score is a function of how much credit you have.
Okay.
Whether or not you pay on time.
Right.
And at least a minimum payment. How much you carry over.
Okay.
Yeah.
How much? What is it called? How many times people are doing an investigation or doing a hard pull on yours? How old your credit is.
Okay.
Because what happens, a lot of people, when they try to fix their credit or drive their score up, sometimes you'll see them canceling their credit cards. Don't do that. Okay. Because the age of the credit or the credit relationship plays a factor in your overall score. Just make sure you want to, and it also hurts if you have credit for a long time and don't use it. You want to use it every now and then. That could lead to what you just mentioned, thin credit, because people want to basically evaluate your ability to conduct transactions, meet your obligations, and meet them in a timely fashion.
So I did not know that. I was today's years old when I knew that. So you would advise, like if you have, because when you look at your DTI and you're trying to balance out the debt to, your debt to income, sometimes you look at all of these credit cards that you have. So you want to keep the older ones. You need to keep the mature ones. And kind of like, so there's a science to like an algorithm.
And that's a benefit of, as her mom mentioned, working with a HUD certified housing counselor to help you understand how to manage or essentially consolidate some of that debt. openly, when we are thinking about the credit report, it can be daunting. The credit score can be daunting because sometimes if you don't know what your score is now and you go to borrow some money, you might be disappointed in the response you get from the lender, right? Because you just didn't do the research, you just don't know, right? So I think the
Okay.
first step is for a consumer, pull your credit report. All right, you get a
Right.
free credit report. You should pull your credit report. Find out what your score is, and at that point, start to do the assessment. Like Herman
Right.
mentioned, credit age plays a big part, right? So if you have 3 lines of credit that you just opened in a year, you can't
Right.
expect to have an 800 credit score, right? But if you have the credit card that you've been paying on faithfully
Right.
for the last 6, 7, 8 years, if you look at the algorithm of a credit report, because if you can go on your mobile apps and be able to go to a credit reporting entity, and they'll be able to give you a breakdown of how your credit report is reviewed. That credit age plays a big part in what your credit score will be, and that older credit age shows that you are credit worthy to a lender. So it's attractive to a lender to have open credit for a longer period of time.
Okay. Okay. So that leads me to this next question. So we talked about credit scores and the contributing factors of what those credit scores mean and how they are. But explain to people, like, what does credit actually matter, and what's a base score, if you will, that
So
people kind of need to kind of get the ball rolling.
I'll jump in on that one. So basically, a credit score is a 3-digit number that is calculated based upon your credit report by scoring models like you hear people talk about FICO and Vantage. And it's calculated based on factors like your payment history. Do you pay on time or are you late?
Okay.
Your credit utilization. How much of your credit are you using? Are you maxed out or do you have some room to spare? The length that we've just been talking about, the length of your credit history. Rulon mentioned your credit mix. Your credit
Right.
mix refers to the variety of credit accounts in your credit profile. And they fall into basically two, if I'm not mistaken, two main categories. It's
Okay.
revolving credit, and those are
Okay.
accounts that you can borrow from repeatedly up to a specified limit. And that's like your credit cards or home equity loans.
Mm-hmm.
Then you've also got your installment credit. And these are lump sum loans that are repaid over set terms like your auto loan, your mortgage, or your student loans.
Okay.
They also look at new credit inquiries. How many times? And is it a hard pull? Is it a soft pull?
Okay.
So all these factors figure into your credit score. And a credit score is important because lenders use it to quickly assess the risk associated with whether or not to approve your loan applications or your credit applications.
Okay.
The higher the score, the better. Typically, they range between 300 and 850.
Ooh.
And the higher the score, the better the terms.
Right.
The lower the score, the higher the perceived risk of lending you money. So it's going to be more expensive.
A 300, isn't that just for your name? Like,
yeah, that's the SAT, but you might as well take it.
So yeah, what's a good credit score, right? So as her mom mentioned, it goes from 300 to 850.
okay.
So yeah, the higher is always better. When it comes to Wells Fargo, we look at the very least, in order to get the best rate, meaning you're going to pay less over the length of the loan, the life of the loan, we want a minimum of 740,
Okay.
right? Officially, it depends on what type of loan you have. So conforming, which are anything under 800,000-ish, I want a 740. For the jumbo loans above 800,000, we want at least an 800 in order to get the best rate. But
800,000. Woo.
No, not 800,000. Yeah, so you want a score of 800 at least, right? So, if that's some of the audience perhaps, or maybe not, but at the very least, you want 740,
Okay.
and it behooves you again to go look at your credit score to pull it to
Okay.
see what it's looking like. I'll give you a quick story. So, I was looking to refinance during COVID when rates were lower, and pulled my credit report, and there was a DirecTV default on a DirecTV payment in Las Vegas, and I don't live in Las Vegas. Someone stole my credit.
Oh, wow.
So I had to go clean that up. It took like a month or so, month and a half to clean that up. And then boom, my credit report, my FICO score went up by over 100 points.
Oh wow.
So that's why it's beneficial. And then because of it went up 100 points, then I was able to get the best rate.
Right.
But if I didn't do that, didn't look into it, and I was ready to jump on the really fantastic rate I had in front of me, I would have been paying more every single month for the next 30 years on my mortgage.
Right.
So
Right.
that's why it's so beneficial
Important.
to get that
Ooh,
higher FICO score.
Yeah.
Let me jump on that example because so that was a situation where Martin identified the issue and acted upon it. But if that rate was time sensitive, because there was an error on his credit report, the time it would take him to get it corrected and off his credit report, that rate may change and go up, and you may miss that opportunity. So
Gotcha.
that's why you want to look at and monitor your credit report on a regular basis.
So I
Yep.
remember when I took the class, they said something about 5 C's, but I don't remember what that was. What are the 5 C's of credit?
So I'll throw one out there.
Okay.
Capital,
Okay.
right?
Okay.
Having enough assets or capital to be able to repay a debt.
Mhm.
Another one that's top of mind for me is they say character, but it's kind of your credit history, right?
Okay.
Your ability to repay. And
Okay.
that's usually seen in a credit report, right? Your behavior when it comes
Mhm.
down to repaying a debt, right? So the character of you as someone who's a consumer borrowing
Mhm.
money, what does your track record show? Right. That's one of the other C's as well too. I believe it's capacity is one.
Capacity,
Yeah, and I'm
Okay.
shooting from the hip.
collateral,
Conditions, I think
I
market
just remember
conditions,
the term.
collateral conditions. There you go.
collateral.
Okay.
Yep.
Yep.
Okay.
They want to make sure you got skin in the game. Everybody wants to make sure you got skin in the
Yeah.
game.
That
And
makes
a
sense.
lot, yeah, and a lot of that is so for example, so we'll go in reverse. So the 5 C's: character,
Okay.
capacity,
Okay.
capital, collateral, and conditions. The
Okay.
conditions part sort of out of your control, right? That's the rates, that's the right.
Mhm.
That's you really can't control that part of it, right?
Right.
But the other 4, you have some ability to make sure that you're in a good space when it comes down to your credit. If you have the
Mhm.
collateral, the capacity, right? You have the capital, and you have a good credit history and good
Right.
behavior with credit. Mhm.
Okay. So, Herman, talk to us a little bit. We keep hearing the terms soft pull, hard pull, soft pull, hard pull. What does that mean? Like I know a lot of
So
people are saying, "What
a
is that?"
soft pull is when they're just trying to find out about you, find
Okay.
out something about you, your character or something like that. A hard pull is when they want to get up in the details because they're about to lend you some money.
Right.
Right.
Soft pulls don't really adversely affect your credit score. Hard pulls, you get enough of them, they can bring your
So
credit
how?
score down because it means why are you going out and getting all this credit?
Right. But how? Like if you're shopping for a car and they go and they
Mhm.
shop you to 12 different
Mhm.
banks to get the best rate. How do you control that? Now you've got 12 hard pulls because you might have gotten
Well,
1% with one and then 0.9 at the other. And I
so
probably should go more basic 3 and 5. I'm just telling you what my score.
so I will say this: my strategy whenever I want to get a car, what I do is this is why it pays to know your credit score. If you
Okay.
know your credit score, you can go into the dealer and say, okay, my credit score is 740.
Right.
What's your rate there? Well, let us
Right.
put no, I know it. You don't have to pull it. Just tell me, you should know your rate. What's your rate for a 740 credit score? And then you
Okay.
can go in to banks and other options to
Right.
figure out, okay, if I know my credit score is 740, tell me what your rate is. So you rate shop, but they don't have to pull your credit because you know your credit score.
That's right. Rate shop before you go in, right, Herman?
Yep.
I
Right.
mean, you should know what because don't go into a dealership and say, "Hey, what can you get me?" And that's it. It's like what the best is out there because you did the research. Can they beat that? That's the
Yeah.
question.
Yep.
Yeah.
Yeah, because I remember I was livid. They shopped me to like 4 people. I was like, no, why would you do that? I mean, I was just upset when I knew what I wanted and I knew where I wanted to go because
Yeah.
I came in with you know how you get those deals? I came in with like a USAA deal thing. So I was like, I knew where I wanted to go, but they will just like do it on their own.
So
Like just be
they
leery of
can't do it if they don't have your social security number. One.
Right.
facts.
Right.
Two, the other thing is I like negotiating. I went in, I'll never forget, I was buying a van, and the guy said, "Are you going to let $500 keep you from getting this van?" I'm like, wrong question. Are you going to let $500 keep you from selling me this van?
Right.
He's like, "What do you do for a living?" I'm like, this.
Exactly.
So just there's power in having a good credit score. There's power in knowing your financial situation. It allows you to take control, whether it's buying a house, buying a car, starting a business. You want to have control as much as possible, and being financially astute, knowing what you're working with, gives you power.
Okay, that makes sense. All right, so we touched on thin credit. We touched on what someone does if they have no credit history and thin credit a little bit. Can we elaborate a little bit more? Like, how would you advise someone to kind of beef up their credit, if you will? Like, if you are trying to buy a home, let's say in like the next year or two, what would be your advice?
I would do this. I would say, one, the general consensus is you want to check your credit score at least once a year. This gives you a clear snapshot of your credit health without any unnecessary monitoring. But there may be special circumstances, like you just outlined, where you want to monitor your credit a little more frequently. For example, if you are looking to improve your credit scores, or if you are preparing for financing, you might consider monitoring your score on a monthly basis.
Okay.
What that does is it allows you to stay motivated because you get to see, the progress and give yourself a pat on the back, but also you get to catch issues early. And that's the important part. Like in Martin's example, you catch issues early. Another situation, when you're about to embark upon a major purchase, like a home or a car, you should check a few months before you formally apply for a loan. And then again, right before applying, to ensure accuracy and to identify any potential obstacles.
Okay.
Yeah, and so I think everyone's situation is different. So we don't encourage people to go take out a loan just to beef up a credit score only for that. But if you need a loan, you need a loan, right? But I think the best advice would be to contact a HUD certified housing counselor and there's websites down there, right? nfcc.org, nfcc.org. Sit down with someone for free to learn about what your next step should be. They'll help you pull the credit report. They'll help you understand what it means and see what the next steps are. Or do you even need, if this is all confusing, they'll help you understand what you need and don't need.
Right. Well, Martin, we talked about the pulls and stuff. How does that actually impact your credit? If someone does have, let's say, 10 hard pulls, does that drop your score?
It could drop your score. So soft pulls do not impact it. So I know NFCC can do soft pulls. But hard pulls, that's where they're actually looking like you're trying to get credit with us. You're trying to buy a car. You're trying to open up a credit card, trying to go to Macy's and get an account there too. Yeah, absolutely. It will affect your score. So be gentle with your hard pulls, I would say.
Yeah.
Right.
Only get things you need. If you're looking at purchasing a home where hard pulling your credit, which therefore decreases your FICO, which therefore can mean increased payment for the next 360 months, 30 years,
wow.
right?
Wow.
Just be careful with it. So sit down with someone and get to know what your options are, I would say.
Good point.
Okay.
Really good point. Yeah, really good point.
Can I raise one thing about thin credit?
Yes.
Okay. So a lot of people hear thin credit and they get scared. All thin credit means is that you have very little credit history. And that makes it hard for credit bureaus to assess your credit worthiness.
Okay.
And sometimes, because it's so thin, they can't even generate a score. So, and this thin credit means you have few accounts, often fewer than 5 accounts, or your new or short-lived accounts that you've only opened in the last with under a year.
Okay.
The people who typically have thin credits are young adults who are just now coming into adulthood, people who avoid credit and prefer to do business in cash because that's how they were raised. Like, I don't want to fool with the whole foolishness. But our society is now increasingly credit oriented. Recent immigrants, new to the country, got to establish their profile here in the States, and individuals who opened accounts a long time ago and haven't used them in recent years. So those are the people who typically have thin credit. And that thin credit, as I said, makes you harder to qualify, harder for bureaus to evaluate risk, and harder for you to get approved.
Right.
That's a good point, Armand. When from a financial institution's perspective, once you walk into a bank branch to talk about products and programs, the banks are assuming that you already did the homework, right?
Yeah.
So now it's time to start talking about products and programs.
Mhm.
So it's really on, our audience to make sure that they have everything in order and ready to roll. And obviously working with HUD certified housing counseling agencies is so important because they're able to have a deeper conversation than your bank can, right? They can talk about your finances and the reasons why. There's a limit to what a financial institution is going to probe around when it
Right.
comes down to your finances, right? So you might turn around and be interested in getting approved for a mortgage, get pre-approved for a mortgage, and there's essentially a hard or soft pull that comes along with that. And then once it's denied or you know that you're not able to get that, what do you do next, right? Because you weren't prepared to understand what the steps are when you start to have that conversation with your bank. Don't let that be the first step, just talking to your bank right out, right?
Yeah.
Make sure
Yeah.
that you're getting your credit report, understanding what your credit score is, and
Right.
being prepared. So when you have that conversation, you're operating in confidence when you talk to the bank.
Absolutely.
The,
One,
the other
one,
thing, I'm
go ahead.
sorry, I'll be
No,
quiet.
good. No.
The other thing we're working at,
We're here to talk, Armand.
I get excited. I get
Yeah.
excited. When you work with like the NFCC, one is no judgment. So you might have some blemish.
Right.
Notice I said blemish. You got blemishes on your credit. That's okay. That's what we deal with. That's why we exist, to help you fix that, address
Right.
that, and think of us as not a judge, but we're your coach.
Yes.
We know
That's
we know
right.
the game
That's
plan,
right.
we know the rules, we know the resources. So you may come in looking to get your credit fixed, and all of a sudden we teach you about the home buying process, who's involved. We connect you with down payment assistance. We let you
Right.
know what you qualify for. So you may have come in for one thing, but we line up a whole line of other resources and opportunities. You're like, man, I'm glad I did this. So
Exactly. Just like people are saying they're glad that they're tuned in today, which is why I want to remind those who are just tuning in that you are watching Paving the Way Forward is presented by Wells Fargo Home Mortgage and NFCC, the National Foundation of Credit Counseling. I'm your host, your Radio Love Asia with Urban One and Radio One. And joining us is Rulan with Wells Fargo, Herman from NFCC, and Martin from Wells Fargo as well. Listen, we are talking today about demystifying credit scores. We want you to definitely chime in. We want you to send us some inbox questions and all that good stuff. And if you need more information, please visit the website listed below. You can go to nfcc.org, or to learn more about the home buying process, just go to the Wells Fargo mortgage. You can go to and other various grants and other low down payment options that can help you make the buying choice that you need. And you can also look at the website listed below, and that is wellsfargo.com/mortgage education for more details. So that you said something that hit a nerve, Herman. You were talking about low credit scores. Now that's like a common question. People are always like, oh, well, I had a divorce. Oh, I had a change of I decided to change my career. I lost a loved one. Like significant life changes can often cause some hiccups in your life. So how does one kind of get back on track with a missed payment? And how much does a missed payment or two or three
well,
affect your credit? How can you recover?
I'll tell you like this. COVID was
Okay.
nobody's fault.
No.
Wasn't it? We did and nothing like that. But because it happened, it had a significant ripple effect.
Right.
People lost jobs, had reduction in hours. There was illness. So a breadwinner all of a sudden is down and can't earn. So all of a sudden the household had a reduction in revenue coming into the home.
Right.
Part of it is understanding that this is not the end.
Okay.
The option you have is get a coach, get a HUD certified housing counseling or credit counseling organization like the National Foundation for Credit Counseling. And what we will do is create a tailored action plan that looks at your unique circumstances and help you to understand. Part of the challenge is that we respond and react to symptoms,
Right.
not the behavior.
Okay.
Working with a HUD certified credit counseling nonprofit, what we do is we get at the behavior. Like, do you have a budget? A budget is a financial plan that tracks how you spend and directs where you spend so that you hit your A priorities, your B priorities, C priorities in a logical, methodical order. And it reduces the risk of you overspending.
Right.
So getting that help and putting together a budget that's your financial plan that directs your spending behavior, that allows you to put some aside so that you have an emergency account, starts to make you less vulnerable to circumstances and gives you control so that you can be thebomb.com.
Okay.
There you
Rulon,
go.
I see
Yeah.
you over there shaking your
So
head. You're like, you want to
listen,
jump
Martin and I, we advocated for housing counseling for years, right?
Okay.
Because listen, her mom mentioned they're life coaches, marriage counselors, financial coaches. Oh, and did he mention that it's free? Right.
Right.
And
Right.
so ultimately, you know, when you're working with a housing counselor, you have that conversation and you can dive in personally. I went through a divorce, my income got cut in half. I want to get back into a place where I can buy a home again or get a credit card. What do I need to do? Right. That housing counseling organization is going to be able to lead that person
Mm-hmm.
in the right direction, help them get prepared, help them with their budget in
Right.
their new world after whatever catastrophe
After
or
the chaos.
life event, right? So,
Right.
but then the great part about that is when you're ready, those housing counseling organizations also have relationships with financial institutions, with banks, with credit unions. So they're going to say, all right, you're ready now. Let me contact my partners over at Wells Fargo
Right.
because you're ready for this, right? So there is a symbiotic relationship between that life cycle that a consumer goes through when they go through a life challenge, right?
Right.
Don't you know, you get a divorce, don't go straight to the bank and say, all right, I need a new car.
You know,
Yeah.
that's how you
Right?
handle the grief.
Yeah.
Retail
I mean,
therapy.
but
Retail
handle
therapy.
handle it responsibly. Because what's going to happen is, as a bank, we're going to say, okay, let's give you an application,
Right.
And
right?
Right.
we know that people operate sometimes from pride.
Yes.
And it says in the good book, pride goeth before the fall.
Okay.
Our philosophy is don't let your pride get you put outside. If you
Okay.
need help, come get that help.
You need
It's
to put
chilly
that on a
outside.
T-shirt. Don't let your pride
Get you put
put
outside.
NFCC on the back. That's a great T-shirt. That's awesome.
There you go.
Um,
So we talked about missing a payment. We talked about life altering things. Let's talk about credit limits and credit utilization because that's also a factor too, right? Martin, I see you over there shaking your head. Talk to us about what that means, like credit utilization. How does that tie into rate factors and stuff?
All right, so let's talk about credit card. That's probably the easiest way to understand, right? So you apply for a credit card through Wells Fargo, whoever, and you get you have a credit limit of $10,000. So there's a whole formula how they figure out how you get a $10,000 credit limit based upon your income, most likely, household income, and other expenses you may have. All right, I have a $10,000 limit on my credit card. So every month, does that mean I go out and spend $10,000 on that credit card? Probably not. Hopefully not. I don't know what I'm buying with $10,000, right? But part of the FICO, the formula for generating your FICO score is looking at what is the credit utilization. So of that 10,000, probably, I don't know, I spend $1,000 a month on that credit card just with
A month?
everyday stuff,
Whoa.
right?
Okay.
Right? And hopefully I pay it off, right? But say $1,000 going grocery shopping or buying whatever got to do, right? But then that equates to $1,000 of the 10,000. That's a 10% credit utilization. So we want to keep that number on the lower side. So the way, if it's on a higher side, say every month I spend $8,000, $9,000. That means I'm butting up to that 10,000 of my credit limit is very, very close to it. And the bank or the lender sees that as a risk.
Right.
And that's also the way the FICO score goes. It's a risk because I can't manage money well, right? I can't,
Right.
I'm giving all this money and I go spend it all. So the lower amount is the better amount when it comes to credit utilization because that factors into the FICO score and how it's graded.
Right. So
And it looks
typically,
like
is the rule basically like half? Is that the best rule? I've heard that before.
Well, it depends on all of the other factors that are involved in what your score will be, right? So you can have stellar payment history, you can have old accounts, you can have a good credit mix, but if you're at 90% utilization, then your score isn't going to be high because the risk of default is so much higher because
Right.
you're right on the cusp of using all of the available liquid that you have in that credit card, right?
Okay. Mhm.
So from a credit perspective, that's risky, right?
Right.
Right. So the adverse to that is, let's just say you only have a 5 or 10% utilization on a credit card. You don't have a really diverse credit mix. You might have an auto loan and a credit card, but you're paying your payments on time and you had those for years. That math might equal to a higher credit score. So utilization plays a big part in what your score will be, because it's really one of the key factors in showing your credit worthiness. And
Okay.
like Martin mentioned, if I give you a credit card for 10,000, are you going to spend $9,999 in a month and not be able to pay that back in your
I'm
monthly
like, in a
payments?
month.
Yeah,
So
I don't
Yeah.
know
here's
what you're
another,
buying, but
this this is a great exercise. So for the audience, what you might want to do is, when you get all your statements from all your credit cards, just get a sheet of paper and look at what your limit is and what your balance is.
Okay.
right,
Mhm.
That will be a good exercise to say, am I using credit to subsidize my lifestyle?
Okay.
And the higher the mix, the worse off you might be.
But where
So
should they be? Should they be around the 50 mark or lower? Like,
I would go,
give them
I would
a
use what we said for a house. If you use like 30%,
hmm
that would be great.
okay.
I'll say this: if it's at zero, you're winning. If it's at zero, you're
But
winning.
how? But that's
But
the
that's
thing.
but that's
But
not but
then
that's not
credit.
realistic. That's not
Yeah.
realistic in life. So Asia, it's really difficult to pinpoint an accurate number, because it's a mix of just your behavior from a
Okay.
credit perspective. It's a mix. So, you might like to use that credit card, but you've been paying on-time payments with all of your obligations for the last 10 or 15 years. That's going to make your score look amazing, right?
Mm-hmm.
But that utilization plays a big part in it. So 50% might work for someone that has all of the other features in a positive space,
Okay.
but it
Mhm.
might not work for someone who has 50% utilization and they only have one credit card and they missed their last 5 payments, right? That's a different mix. So at that point, 50%
Yeah.
utilization, you're in the red, as opposed to someone that might have stellar credit and they may have a small business and they leverage their credit card to pay some business expenses, but they pay it off. So that utilization isn't a big factor because they're
Okay.
able to manage their finances.
So, we often hear things that kind of mislead consumers. So let's talk about that. Like, are there credit myths that people are often told?
There's a lot.
Martin, I'll let you touch that one. Yeah.
All right, I got one. I got one to start off with. The one credit myth is what's good credit and student loan. I have student loan credit. That's good credit. Well, credit's credit, right? I know people see it as good credit because it went and got a degree and therefore they'll make more money. But you got to do the math. What's the return on investment? I spent, this is my example, not my personal example, but someone spent $50,000 on a master's degree for something that is going to increase your salary by $10,000 a year or $5,000 or nothing. Like, is it worth it? It doesn't. So you got to look at what doesn't make sense always to bring on more debt. So is there such thing as good debt? I would say the good debt is the debt you pay off, right? The debt you can manage, the debt that the payment's not going to surprise you and won't bear you.
Mm-hmm.
Yeah. Yeah.
For me, the best type of credit is good credit.
Right.
hmm
That's it.
But
Just have good credit.
how do they grade you? Because you talked about report cards. How do they give you an A if it's at a 0 and you paid it all off? But so we don't know your
Well,
ability to
if,
repay.
if you're
You just
paying,
keep paying it all off.
if you keep paying it off, you're good, because you're
Right.
using the credit. It's revolving. You're meeting your financial obligations in a timely fashion. You got a great. You should have a great credit score. You didn't miss any payments. You paid on time. Every time you use your card, you pay off the full balance that month. You're golden.
Yep.
Okay.
You're looking good if you're making your payments on time every month, right? Because if you
Mm-hmm.
go over 30 days past due, a creditor might hit your credit, right?
Mm-hmm.
So paying on time, utilization is low. Obviously, it being zero is, I wouldn't say unrealistic, but that means you are a savant in the finance space if you are keeping it at zero. Because
You're
Right.
paying
I
on
wish I could
cash.
keep mine at
Yeah,
zero, right?
yeah.
but
I,
but keeping your utilization low, right? Having that credit link, that age, that credit history, like being
right.
able to show that you've been paying your obligations, you've been borrowing, you've been doing this for a long time. And sometimes that's, you have a car, car loans 5 years, you pay the car off or you trade it in, like that debt is wiped out, but it's still showing as an open piece of credit on your credit report. And that's positive for you because now you're getting into another car you finance. So you were able to close that installment debt and then open up something new. So the age plays a big part in it as well too. Credit mix, having a variety, as her mom mentioned, of different things, whether that's auto loan, credit card, mortgage, right? That
Right.
plays into it as well too. And then, not falling into the trap of looking to get new credit just to get new credit, right? The hard inquiries
Okay.
that will create issues with your score. Because one thing about a hard inquiry is it'll remain on your credit report for 2 years,
Right.
right? And so it's going to be there. So even when you clean up your credit, you still see that hard inquiry that was there, maybe for a car that you were looking to purchase, right?
Mhm.
And so that's a mix of different things that create the A in your report card,
Right.
right? Doing those things.
They definitely get me all the time. Like if I'm at the register and they're like, "Hey, you're automatically approved for a credit card and you get 30% off." I'm like, "Okay, give it to me,"
Mhm.
because I want the 30% off. But I make sure I pay it off right away.
Hey, Herman, I know in preparing for this, we talked about getting the credit cards where you get the 10% off, and you're talking about, is it always worth it? You want to tell your story?
Yeah, so they're going to come at you as Asia indicated. Hey, you get 10%, 20% off. I'm gonna get 10% off a t-shirt. Really? I'm gonna say that. I'm gonna do that. I'm buying a house. I'm buying a car.
Yes.
Where that 10, 20% represents multiple hundreds or thousands of dollars. I'm getting a
Right.
washer dryer or something like that, not a $10 t-shirt where I get a
Herman,
dollar.
I'm a girl. I have more than a t-shirt in my car. I saved some money off that purchase, okay? But
Yeah.
Damn.
so that leads me to my next question. What exactly is good credit? Is there such thing? I mean, like when we talk about like what's the best type of credit? Is a car the best type of credit? The revolving credit cards, are they the best type of credit? When you need a thicker package, what's the best?
It's all relative. It's all relative
Okay.
to your financial situation, right?
Okay.
Let's just say you're buying a house. That's going to feel a little different from if you're buying a car, right?
Okay.
Bigger
Right.
obligation, more money that's being loaned from the bank. So yeah, that lender is going to take a deeper dive into your credit score. So good in that space may be the 740s, the 750s. There's a myth out there that you need 800 credit score to get a mortgage. That's not true, right? So just making sure that you have good credit in general is advantageous for a mortgage. Now, auto loan might feel a little different. It may not be, it's still debt that you're borrowing, but it's all relative to your situation. Do you need a mortgage in order to get a car? No. But ultimately, you still want to make sure you have a good credit score. So that way you're able to get that purchase that you're looking to get. But it's all relative based upon what you're looking to buy. Are you looking to buy a
Right.
home? Are you looking to open a
Right.
new credit card, right? It all feels different and it's all based upon your behavior as a consumer,
So
right? And being
what
able to manage the debt.
And
so what exactly is the best way to improve your credit score in a like over time or quickly, rather, if you're looking to buy something in the next year or two?
All right. So quickly, there's not much you can do quickly. The quickest you can do is if there's an error on your credit score, clean that thing up. Because if
Okay.
it's, especially if it's a negative, something negative is going on because your credit was stolen, that's
Mhm.
something quick. With a month or two, you can clean it up, right? But if there's no errors on your credit score because you missed 3 payments or whatever, there's really nothing quick about it. I mean, just from the next day, from tomorrow, start making your payment on time, at the very least a minimum, hopefully even more. Bring down your utilization. Just be a good risk for the lender. And going back to your question about what is a good credit, what was the question? What's good credit, right?
Right. What
I-
would be a
Yeah,
good
I,
types of
I,
credit?
I don't think it's the type of credit. I think it's the best interest rate you can get,
the
right? So
cost
think
of
about
credit.
the example about the car, buying a car example, right? You go in knowing what's the best you can get out there, and can you beat that rate? Not just taking what they give you. So
Right.
getting the best rate you can with your mortgage, with your car, with everything, and not jumping into something for 10% off a t-shirt, Herman.
Yes, yes. There was
Herman,
there used to
healthy
be
credit
a
counseling.
a
I'm
store
sorry.
called Cy Sims. It says the best consumer is the educated consumer.
I like that. I like that. Herman, how can credit counseling help someone struggling with their score?
Well, it starts by giving them a detailed review of their credit report and finances, helping them to understand the current situation without any impact on their score. It's a soft pull. Typically, a counselor will personalize budget and money management education, equipping them with the knowledge to improve their financial habits. And like we said before, addressing financial habits is critically important in this scenario because we don't want to treat just the symptoms, such as a low credit score. We want to address the behaviors that manifest the symptoms and cause the problems. The counselor is also going to recommend, potentially, if it fits, enrolling in a debt management plan, a DMP, which helps to consolidate payments into a single monthly amount, and it may even wind up negotiating lower interest rates and maybe even waiving fees. But this is all helpful.
Yes. You know, I always have such a great time with you guys. The time just flies. We have to make these panels like 2 hours long because
I didn't even notice the time.
It's a lot of information. I learned a lot today. You know, Roland, what would you like everybody to take away from today's conversation?
Well, just make sure as you are planning and preparing for your financial journey to visit nfcc.org or wellsfargo.com/mortgage education. Just prepare yourself, educate yourself. And if you need assistance, if you need coaching, we always promote the National Foundation for Credit Counseling, but get as much information as possible. We appreciate you tuning in because we feel like this is a place for a resource.
Yeah.
So continue to lean on us and make sure that you are diving into as much information as possible to make the best decisions.
Okay.
Absolutely.
Martin.
So we did our best to demystify the whole process, credit score. So we also know this is overwhelming for many. It's
Right.
still confusing perhaps, and that's okay. So I'm going to repeat what Roland said, nfcc.org for free assistance to understand all this, to hold your hand through the process and make it really easy and simple. And if you're not ready to buy a home or what it's okay. If you're just dipping your toes, learning about what you need to do to start building credit, to start thinking about it, great place to start, nfcc.org.
I love that. And Herman, your takeaways from today?
Awesome. I will say some of you might not want to use a computer. So if you want to call the NFCC, you can call us at 833-691-6299. Again, that's 833-691-6299. And one thing I will say is that never be afraid or ashamed of getting the help you need. It's okay not to know. What is not okay is knowing there's help and then you making the choice not to take advantage of it. So get this help. We're here.
He
always has
the best sayings. You know what I'm saying? Always. Like always. I'm going to just start writing it down.
It's t-shirt quotes. That's what they are.
Those should probably get you put outside.
Yes. There you go. That's the best one. Listen, we have so enjoyed each one of you today. Again, Paving the Way Forward, presented by Wells Fargo, Home Mortgage, and NFCC, the National Foundation for Credit Counseling. To learn more about the home buying process, as well as various grants and low down payment options available that can help you make your dream a reality, because everybody has that big dream, right? Just visit wellsfargo.com/mortgage education. And for better life beyond debt, you want to visit nfcc.org. I've been so pleased and honored to be your host. I hope to join you again real soon. We'll be back on August 13th, same bat time, same bat channel. Make sure you tune in. We want to thank all of our panelists for joining us today. Once again, you can follow me at Always Ask Asia on Facebook, Instagram, Twitter, and TikTok. Again, that's Always Ask Asia. And before we go, we want to leave you with this.
Buying a home is a major milestone, but it starts long before the search begins. Understanding your credit, managing your debt, and setting a realistic budget are key parts of the journey. That's where credit counseling comes in. Through the National Foundation for Credit Counseling, certified nonprofit counselors provide personalized support to help you take control of your finances and prepare for responsible homeownership. There's no pressure, no hidden costs, just trusted guidance. You'll learn how lenders view your credit, what you can afford, and how to improve your financial profile so when you're ready to buy, you're truly ready. Before you find the right home, find the right path. Start with the National Foundation for Credit Counseling.